In a single day, 1.27 billion ounces of paper silver were traded on COMEX, more than 1.5 times global annual mine supply. While physical Silver Eagle premiums exploded over $16 above spot, and tens of millions of ounces were demanded for COMEX delivery at the same time. That is not three separate stories. That is one market under visible strain, where paper volume is overwhelming price discovery, physical supply is tightening, and delivery demand is rising despite futures pressure. When premiums surge, backwardation appears and delivery notices accelerate, all while billions of ounces trade without metal moving. The structure itself becomes the signal. And the math does not lie. I will explain exactly what that means now. What we are witnessing right now in the silver market is not being driven by headlines or speculative enthusiasm. It is being driven by availability, or more accurately, the lack of it, at the retail and wholesale physical level. When spot silver trades around $1890 and the most widely recognized sovereign coin in the world is being listed between $103 and $105, that premium is not an accident. It is not a marketing decision. It is the result of inventory pressure across the supply chain. Silver Eagles are not generic rounds. They are a U.S. mint product with limited minting capacity, fixed production schedules, and a rigid distribution pipeline. When demand rises sharply, supply cannot be adjusted quickly. The result is premium expansion. That is exactly what is happening here. A premium exceeding $16 over spot tells you one thing very clearly. The futures price is no longer reflecting the cost to actually acquire silver in hand. Futures contracts represent financial exposure. Physical premiums represent immediate delivery risk. When those two diverge this aggressively, the market is signaling stress. This stress is also visible in backwardation. Silver trading in backwardation, even by 30 cents, is not normal. Silver is a monetary metal with storage costs. Under typical conditions, future delivery should be more expensive than immediate delivery. When the opposite occurs, the market is saying that possession today is more valuable than a promise tomorrow. That only happens when holders of physical metal are unwilling to part with it, even for a premium. It reflects urgency, not speculation. Now look at the COMEX delivery data. Over 500 delivery notices issued in a single day is not a quiet market. These are not paper trades being rolled or offset. A delivery notice means one thing: someone stood for metal, and metal must be transferred. When one institution issues the majority of those notices, it suggests they are acting as a source of liquidity. Metal is moving out of inventory, not into it. At the same time, other major institutions stopping contracts indicates metal is being absorbed rather than circulated. The cumulative January total crossing 7,700 contracts, representing over 38 million ounces, is significant. That volume is not noise. That is metal being demanded inside a system designed primarily for price discovery, not mass physical settlement. The key point here is not price, it is flow. Metal is moving from exchange vaults toward end holders. Premiums are expanding because replacement cost is rising. Backwardation is appearing because sellers prefer to wait rather than part with inventory now. Delivery volumes are increasing because counterparties are choosing metal instead of cash settlement. None of this requires speculation about motives or intent. These are mechanical outcomes. When futures are pressured lower while premiums rise, it tells you that paper supply is abundant, but physical supply is constrained. When delivery activity accelerates during that divergence, it tells you that confidence in future availability is weakening. This is how stress manifests in commodity markets, quietly, structurally, and before it becomes obvious in price charts alone. The silver market is not breaking. It is doing exactly what markets do when physical demand begins to dominate financial positioning. And the data is speaking very clearly. In one single trading day, more than 253,000 silver futures contracts changed hands on the COMEX. Each contract represents 5,000 ounces, Do the math. That is approximately 1.27 billion ounces of silver traded in one day. To put that in physical terms, that is nearly 39,500 metric tons of silver, roughly 1.5 times the entire annual global mine supply, traded in 24 hours. Now pause for a moment and ask a simple question. Did 1.5 years of the world's silver production actually change ownership yesterday? Of course not. The overwhelming majority of these contracts will never result in metal delivery. They will be offset, rolled, or settled financially. That is not an opinion. It is how the futures market is structurally designed to operate. This is where the distinction between paper silver and physical silver becomes critical. Futures markets were originally created for hedging and price discovery, but when daily trading volume exceeds realistic physical availability by an order of magnitude, price discovery becomes distorted. At that point, the market is no longer discovering the price of silver, it is discovering the price of leverage. Paper silver can be created in unlimited quantities. Contracts can be written, traded, and closed without a single ounce moving. Physical silver cannot be expanded that way. It must be mined, refined, minted, transported, insured, and stored. Those two markets are operating under very different constraints. When billions of ounces of paper exposure trade against a physical market that is already experiencing tightness, visible through elevated premiums, delivery demand, and backwardation, the disconnect becomes obvious. This is not about retail sentiment. This is not about ETFs. This is not about emotion. This is about math. A market where paper volume regularly dwarfs physical availability cannot accurately signal scarcity. Instead, it amplifies volatility while masking supply stress. That is why you can see futures prices pressured while physical premiums rise at the same time. One market is absorbing leverage, the other is absorbing metal. When the majority of participants know they can settle with cash instead of delivery, the incentive structure shifts. Contracts become financial instruments, not claims on real material. And when confidence in future availability weakens, physical holders become less willing to sell, regardless of paper price signals. That is when you see tightness emerge quietly, not through headlines, but through behavior. Inventory turnover slows, delivery volumes rise, immediate metal commands a premium, future promises become less trusted. None of this requires speculation about intent or coordination. It is the natural outcome of a system where paper exposure vastly exceeds physical backing. The important takeaway is not that paper markets exist, they always have. The takeaway is scale. When daily paper volume approaches or exceeds annual global supply, the signal being sent is no longer about silver itself, it is about the structure of the market that trades it. Physical silver cannot be printed, it cannot be rehypothecated endlessly, it cannot be settled away with accounting entries. At some point, the only thing that matters is what exists and where it exists, and right now, the numbers are not whispering. This video is for educational purposes only and is not financial advice.